Well, my next guest is a little more optimistic. He still sees a soft landing in the cards, says the Fed is done hiking regardless. Joining me for more is Michael Gapen. He's head of U.S. economics at Bank of America Securities. I don't mean to put you up against Jamie. At least he's not your boss, Michael, but, still. I thought those comments were quite interesting. Why do you have a little bit more glass half full take on things?
I guess I wouldn't agree that the economy is in a sugar high per se. I think, yes, if you look at the Q3 GDP data at 5.2%, you think, wow, things are roaring. But and they were in that quarter. But I do think some of that is more of a one-off. And there are reasons to suspect that the economy is going to moderate. So, yes, I would agree with him in the sense that some of the growth has been driven by fiscal policy as well as prior monetary policy easing. But we've been tightening policy for a long time, and we're engaged in quantitative tightening. And fiscal stimulus is likely to run its course. So we just think that consumer balance sheets are strong enough. We think that the labor market will hold up enough, where some of the outperformance in 2023, which was driven mostly by the consumer over the course of the year, will keep the economy out of recession in 2024. So we look for a slowdown.
Yeah.
And we do have concerns about a sharper drop-off in activity, but I don't think we're seeing that yet.
One more, then I want to ask you about the Fed, but it's interesting that consumers writ large seem to almost share Jamie Dimon's view of things, where you look at the consumer sentiment data, the expectations numbers have been very bad. There's still the majority of people expect that we're going into recession. So he's picking up on something out there that maybe the data can't tell us, but people's instincts can somehow tell us of, chickens haven't yet come home to roost.
I think there's some truth to that, and I think it's fair that there's a difference between somebody like me who looks at the aggregate statistics and then looking at the position of an individual household, where inflation matters a lot, where the cost of home ownership and higher mortgage rates matter a lot. So food and energy prices tend to reflect more strongly on sentiment. But in the aggregate sense, last year we added millions to the workforce. And that means greater growth in overall income, so the economy, consumption as a whole can keep growing. So I do think that there's a gap between what the individual household feels and what the aggregate household feels. And I think what the narrative could be is, well, what if the labor market slows down? What if labor demand slows down? Then that negative sentiment could take hold, and you could see a sharper pullback in consumption. Not our baseline view, but certainly a risk we're watching.
Right. It's sort of, we all know that once that, if or when that happens, game over. But in the meantime,
right.
So
right.
You think either way the Fed is done hiking, and the first cut is June?
Yeah, that's right. We do. So certainly I think, like you've been hearing from some Fed members this week, the data since the November meeting have gone in the direction of softer growth in economic activity, slower employment growth, and some diminishment in inflation. Is it enough to get them cutting in early 2024? Probably not. But I think the messaging will shift from hawkish holds, hey, we didn't hike today, but we could, to a world where more of it's like a dovish hold. Things are moving in our direction, but it's about enough confidence before we start cuts. And for us, that means probably you're getting cuts around the middle of the year, although if activity falls off more sharply, you'll get them sooner. But I think it's that hawkish hold to dovish hold transition that we're in right now.
I know that they know intellectually they should bring down the Fed funds rate if inflation keeps falling, but I still doubt they would do it for that reason. I think it's just really hard to explain and communicate. So what do you think is going to happen with the inflation rate? Do we stall out here? Does it move down more sharply? What do you think?
I think relative to where markets are, we think inflation comes down, but a little more slowly. And that's mainly because what's left in the disinflation process to get it all the way down to 2 is disinflation in services. And if you look back in time, services never has deflation. Services prices as a whole never really fall. They just rise more slowly. So I think we're at the harder part right now, where we need to get services inflation down. And we think that's going to take longer. We think it still happens. And we think it does open the door for a gradual, cautious cutting cycle, of communication issues aside. But we have it getting down to the Fed's target by the end of 2025, but still being slightly above 2% at that time. So directionally, we're the same, but we have things coming down more slowly.